In today's video, we're starting out by looking at a chart of the Euro US dollar, and we're doing that because there is something very interesting happening today. So the Fed, as transparent as they are, and they actually are quite transparent. Most of the things that they do, you can find out about it very easily, and I'm going to show you what I mean here right now. But what traders may or may not realize is that the Fed is largely responsible for a lot of the inflation in the U.S. They inflate on purpose, or they'll slow that inflation on purpose. And this is not necessarily bad. It's part of their charter and responsibility as the central bank in the United States. Now, one of the ways in which they'll do this is they will adjust reserve requirements for banks, meaning how much money do you have to have on deposit versus how much money you've lent out, things like this. They will adjust interbank lending rates, so they will manipulate through the buying and selling of securities and T-bills, T-notes, things like that. What kinds of interest rates are being charged from one bank to the other? And that's largely what we call the target rate, as a matter of fact. So whenever you're looking at the interest rate that they're managing, that's the interest rate that they manage. Then they also charge interest from the discount window. So if a bank isn't going to borrow from other banks and they need to have access to capital, the lender of last resort is the Federal Reserve, and there is a separate interest rate charge for that, and they can adjust that up and down as well. And by moving these things, they're able to control money supply. Well, for the last year, they've been inflating like crazy, which means that they've been pushing tons and tons of U.S. dollars into the market. Every day I get an email from the Fed that says, we've pushed this much money into the market today. We've pushed this much money in the market today. That's not the way that it's always. Every once in a while they will actually pull money out, but they haven't been. It's happened a handful of times in the last year. Every other day has been pushing more money into the market, inflating further. Now, periodically, by the way, one of the things that they do on a regular basis is that they will award loans to different types of securities to their correspondent banks. Well, periodically, these correspondent banks will come for a lot, and the Fed will make a lot available. Now, these spikes, this happens on a daily basis, and every once in a while, these spikes really shoot up. So it may go from $2 billion worth of loans in a particular day to suddenly $15 or $25 billion in a day. So these really extreme spikes are indicative of, well, there's a change going on in the capital market. This is going to affect the Forex. Knowing that when those spikes occur is useful for you as a trader. Let me illustrate. So what I'm going to do is I'm going to put a bunch of arrows on the Euro US dollar on some of the most extreme spikes that we've seen. So basically what I look for is usually they'll spike for a couple of days. So I'll look for that first day's spike. I'll put an arrow on it, and you'll see how that corresponds with disruptions in the trend. By disruptions, I mean reversals. Not surprising, the results basically show that these spikes in injections of loans into the capital market, that's an intent to increase liquidity, and it will inflate the money supply. You can see that they're almost uniformly, since about the beginning of the year, they're uniformly associated with reversals in the value of the dollar. And I'm using the Euro US dollar as a good proxy here, but with one exception there in February, which came right after a big injection about the right in the middle of February, as a matter of fact. So you can see over and over again, this thing has defined either resistance or support levels, and today the same thing is happening. Now, this is not a lock, obviously. There's no such thing in the financial markets, but it is definitely information that has some use. So here is the URL for where you can get this information for yourself if you want to explore a little bit. I find that the information available from the New York Fed is invaluable, because what I'm basically getting to see is what does the trading book look like today for the market's biggest individual participant? I mean, how could that information not be useful? And as you can see here, it's certainly looking for spikes in their activity, certainly correlates to an uncanny level with transitions in the market. Does this mean that the downturn is over and we're in for another transition? I think that's a very high likelihood. So seeing the dollar beginning to weaken from here may not be an absurd assumption, particularly considering the fact that the reason why they would be injecting money into the market is to solve a liquidity problem. So to keep rates where they need to have them, they have to keep inflating over and over and over again. They don't. They're wanting to space these injections out farther and farther. I know, because otherwise their tool becomes less and less effective. Well, as they continue to, every time they do that, it is going to impact the market, and it could indicate that there is going to be additional problems. If this continues to compound on itself, especially over the weekend, then we could see a reemergence of some of the same problems that we get with the credit crisis over the last year reemerging, which is bad for the U.S. dollar. As forex traders, we want that information because we can use it, not only to enter new trades, but potentially to exit trades that may have run their course, such as this one as a bounce down off of resistance here in the beginning of July. Now, if you need some help, this is one thing that I would say is it's not technical analysis. It's kind of fundamental analysis, but it's one of those things that you don't see traders talking about a lot. So I would welcome you to ask questions in the forum. I'd be happy to help explain. I'll put the URL for where to find this kind of information from the New York Fed in the forum as well, and you can check it out there. There is a wealth of information. I get daily emails from the New York Fed about their activity every day, and I find that every once in a while you get a pretty good tip.